Pankaj Tibrewal joins us, Senior Vice President, Fund Manager with Kotak Mutual Funds. Pankaj bhai, good morning. Thank you for joining us. I can see two bulls on air. I am always a bull and the bull behind in a photo frame. Can I say you are the third bull on the screen, or you are right now confused about the market setup?
So good morning, Nikunj bhai. If you ask me from a decade perspective, which will be summation of all short-term and medium-term, I'm an extremely big bull on India. And last 30 years have shown that despite of all the odds, and chronologically, if you just plot every year from 1992 to 2022, every year some of the other event has happened in the country which has made you nervous. Despite of that, India has been the fourth best performing market in the world with a dollar return of more than 7.5%. So if history was to go by, obviously from a medium to long term perspective, I remain a bull. But if you look at from a short term perspective, I think there are some concerns and we need to be cognizant about that. Uh, Global risk rally started around mid of June. And from there, most of the markets have reversed back to their June lows or lower, whereas Indian markets have been isolated to a larger extent. And we are still up by 12 to 13% from our June lows. Incrementally, Nikunj bhai, I think few of the macro indicators are flashing red. I think after a long time, you are seeing that the liquidity in the system, banking system liquidity is being drained out. Uh, and that will weigh on, inflation, that will weigh on rupee, that will weigh on growth at some point of time. And there's a very high correlation between banking system liquidity and market cap to GDP over a longer periods of time. So liquidity is extremely important. The yield curve is flattened out in India, and the earnings minus bond yields are more than negative 2%. So there are some concerns in the near term, but I think what market is reflecting is the optimism on growth and sustainability of growth in India compared to the rest of the world from a medium to long term.
Although when one talks about Pankaj, various pockets in the market, the fact that pound has depreciated 6% against the rupee in just the last two trading sessions, and we all know the way it's come crashing down. The fact that there's clearly an increased risk of sentiment, at least in the UK geography, and as a revenue breakup from UK, many Indian companies are sensitive to that. I mean, a Mastek 68% of its revenues comes in from the UK geography. This First Source, this TCS at 15%, Tata Motors because of the JLR business at a 14%. There's Happiest Minds, there's Tata Consumer Products, there's Mindtree, Tatacom, eClerx, Hindalco. It's a long list out there. Would you be a little circumspect and wary of these companies with exposure to UK?
I think Indian currency, if you leave aside the last few days, has been one of the best performing currency calendar year to date when we look relatively compared to the rest of the world. Uh, British pound is down by more than 20% compared to dollar. Yen is down more than 20% versus dollar. So when you look at relatively, we have been relatively insulated from that currency depreciation side. However, the last few days events obviously bring in the question from a cross-currency headwinds of various companies. And I think over the period of time, we'll come to know what are the impact. But more than the cross-currency headwinds, I think what I am concerned on IT is the demand side momentum slowing down. Though the commentary is still positive by most of the IT companies, but if you look at the global macro situation, my sense is that moving into the third and fourth quarter, you will see IT budget cuts by most global companies, and that will weigh on the demand momentum and revenue growth of Indian IT services. So I think the second leg of downgrade is still awaited in the IT services, and then we should have a fresh look on this sector again.
So would you be wary and bearish across the market cap categories when it comes to IT? That's large caps and mid caps alike, or is there a specific pocket here?
I think mid-cap IT companies are still high on valuation relative to the history. And I think there's still some optimism which has been built in terms of growth. Large caps have post the correction adjusted on valuation terms, and they are still some large caps which have started to look attractive. But I think let's wait and let the earning downgrade cycle play out before taking a fresh look in the sector again.
You've liked sectors like cement, you've liked sectors like home construction, home improvement. These sectors are essentially a function of economic growth, a function of disposable income, a function on ultimately how good you feel about spending. Given that your view on the economy is slightly cautious, I'm sure these sectors will also get affected. Would you be looking at changing the basic core of your portfolio, which was centered around manufacturing, cement, home improvement, real estate?
No, Nikunj bhai, I think when you look at the world, I think India still stands out. And for your viewers and yourself, I think let me give you some data points. Despite of all the global mayhem which is happening, our sense is that India will contribute 1/4 of the incremental GDP growth globally next year. And we will contribute about 28 to 29% incremental GDP growth to the Asia part. And I think that's a substantial number. And probably India would be the engine of growth for the world. And when you look at some of the themes which we have been positive, we continue our positive bias on those themes, and especially manufacturing. Nikunj bhai, let me take a couple of minutes to explain. We did an entire survey of SME and listed corporates across the belt. And the kind of positiveness we are seeing after a very long time across the value chain is unprecedented. It's across auto anks, it's across light engineering, precision goods, capital goods, and the order inflow seems to be very, very strong. Uh, the country has been talking about China Plus for last couple of years, but my sense is that the Euro Plus one could be a bigger theme to play out over the next few years. The energy crisis which is playing out in Europe is unprecedented. From $3 per MMBTU, the gas price 2 years back, we are at $50 per MMBTU. A large production base, which is in Germany and Italy, is having problems in competitiveness. And they are looking to outsource a large part of manufacturing, starting with low value addition to India. And I think India, the biggest advantage is the 1 million engineers which we produce every year, the skilled labor, which is our strength. And my sense is that across many industries which require skilled laborers, one will be positively surprised by the growth. And this momentum is we are seeing after a long time. When Indian entrepreneur doesn't complain, Nikunj bhai, take it for granted that the business is running very good. And across the sectors, we are sensing that, whether it be SME, whether it be medium size, whether it be large corporates, all companies across the value chain are saying that the demand momentum is extremely strong. So manufacturing remains a medium to long-term theme. And I think after a long time, apart from the consumption engine, the manufacturing engine is firing, in my view. And there are enough signs now to say that probably this time around, there won't be a false alarm and manufacturing could surprise us on the upside. So when I look at the entire core economic sectors, though in the near term, there are concerns about liquidity, interest rates, and inflation, but I think if one takes a slightly medium to long term, any dips in these themes and sectors and stocks will be opportunity to increase the allocation.
Given that you're talking about a long-term theme in the form of manufacturing, Pankaj, hi there, morning. How would you be playing this theme exactly? Which sectors, if you could be a little bit more specific, do you think investors can look at?
So I think across the value chain, whether it be capital goods, which will be catering to the high precision, light engineering, consumables, or the short cycle plays, which is linked to production. The second one is the entire auto ancillary space, which is looking very, very strong, led by both domestic upcycle as well as outsourcing by most of the large global players to India. The third one would be the chemical sector, which we have been positive for a long period of time. I think the demand momentum still looks to be very strong out there. And some of the other manufacturing where there is an import substitution. Over and above that, don't forget defense. I think the commentary coming out from most of the defense companies when we are speaking to them, whether it be PSU or private, the sense I am getting is that the cycle has been completely compressed. Anything which used to take 7-8 years, right from concept till the commercial production, is now been coming down to 3.5-4 years. There's an urgency by the government to indigenize most of the defense manufacturing in the country. And when you combine the entire basket together, I think that's what our view will be on the manufacturing side.
What about the outlook when it comes to financials? Given the fact that you've got private banks, NBFCs, etc., they're all in the spotlight. Do you believe that there is merit on banking on the entire financial space as a whole? Where do you stand?
So we remain positive on the entire banking pack, mostly the large private sector banks. And I think they are very well positioned. Over the last 7-8 years, the banking sector has provided enough from an NPA provisioning perspective. Asset quality remains in control. And also the credit growth is picking up, which bodes well for the earnings growth of the sector. So I think from a next 12 to 18 months perspective, financials is one area which we like. And it's a great way to play also the capex recovery in the country.
Pankaj, also wanted to know, that the kind of rotation within sectors which is taking place, and we were just looking at some data within banks as to how, money is moving out of ICICI Bank and finding its way into IndusInd, for instance. Just wanted to understand within banks, where does your preference lie?
Our preference lies for private sector banks. We are not so much excited about the wholesale funded NBFCs or banks. We think that in this cycle, retail oriented banks, where there's a granularity of deposits, probably will do well. Because if you look at the credit growth, we are at more than 16% now, but the deposit growth is not keeping pace. And hence, there will be some push up on the rate side on the deposits. And banks which are more granular on the retail deposits are expected to do well, as we believe that the wholesale funded rates will move up faster than the retail rates. So our preference lies in banks which have very strong retail franchise on the deposit side.
Okay, Pankaj, great to have you on the show. We'll let you go on that note. Good to speak with you as always.
Thank you. Thank you. Pleasure.